Hi, my name is Baljan. Today we're going to talk about financial risk management again, and the lesson is sources of risk. First thing of this lesson is currency risk, which every person usually has occasions and cases in their life, so I think it will be very useful for you. So let's start. Sources of loss and a decomposition. To examine sources of losses, we should consider a plain fixed coupon bond. The potential for loss can be decomposed into the effect of dollar duration, D, P, and the changes in the yield, D and I. The bond's value change is given by dP equals minus D multiplied P, and all of this multiplied to D from E. And this illustrates the general principle that losses can occur because of a combination of two factors. The first one, the exposure to the factor or dollar duration, and is a choice variable, and the second, the movement in the factor itself, which is external to the portfolio. So next, this linear characterization also applies to systematic risk and option delta. We can, for instance, decompose the return on stock IR into a component due to the market RM and some residual risk, which we ignore for now because its effect washes out in a large portfolio. And here we see the formula. R from eta equals alpha plus beta eta and multiplied RM plus E from eta and is approximately equals B eta multiplied R from M. We ignore the constant alpha because it doesn't contribute to risk, as well as the residual E from eta, which is diversified. Specific risk can be defined as a risk that's due to issuer-specific price movements after accounting for general market factors. And we should note that R from eta is expressed here in terms of rate of return and hence has no dimension. To get a change in a dollar price, we write, and we have following formula. As you can see, D from P, eta equals R, and P from eta approximately equals beta multiplied P, and all of them multiplied to R and M. So, similarly, the change in the value of a derivative F can be expressed in terms of the change in the price underlying asset S. We have dF equals delta multiplied D and S. To avoid confusion, we use the conventional notation of delta for the first partial derivative of the option. Changes are expressed in infinitesimal amounts of dF and ds. Equation all reveal that the change in value is linked to an exposure coefficient and a change in market variable, and all of them is in conclusion we have market loss equals exposure multiplied adverse movements in financial variable. To have a loss, we need to have some exposure and an unfavorable move in the risk factor. This decomposition is also useful to understand the drivers of the discontinuities in the portfolio value. This can come from either discontinuous payoffs or from jumps in the risk factors. Discontinuous payoffs arise with some instruments such as a binary option, which pay a fixed amount if the options ends up in the money and none otherwise. Discontinuities can also arise if there are jumps in the risk factors, such as the 1987 stock market crash or due to event risk. Currency risk. Currency risk arises from potential movements in the value of foreign currencies. This includes currency-specific volatility, correlations across currencies, and devaluation risk. currency risk arises in the following environments. In a pure currency float, the external value of a currency is free to move, to depreciate or appreciate as pushed by market forces. An example is the dollar-euro exchange rate. In a fixed currency system, a currency's external value is fixed or pegged to another currency. An example is the Hong Kong dollar, which is fixed against the US dollar. This doesn't mean there is no risk. However, due to possible adjustments in the parity value, call it devaluations or revaluations. In a change in currency regime, a currency that was previously fixed becomes flexible, or vice versa. For instance, the Argentinian peso was fixed against the dollar until 2001 and floated thereafter. Changes in regime can also lower currency risk, as in the recent case of the euro. Currency volatility. In the table, compares the risk matrix volatility forecast for a group of 21 currencies. 10 of these correspond to industrialized countries, the others to emerging markets. These numbers are standard deviation adapted from value at risk, forecast at the 95% confidence level divided 1.645. The table reports daily, monthly, and annualized standard deviations at the end of 2006 and 96. Annual volatilities are obtained from monthly volatilities multiplied by the square root of 12. And we can see this in the table countries, currency code, daily, monthly, annual deviation coefficient, and annual, and the differences between the two periods. And at the next picture we have the graphics which illustrates and the situation about this. So across developed markets, and here describing of the last picture. Across developed markets, volatility typically ranges from 6% to 10% per annum. The Canadian dollar is notably lower at 4% to 6% volatility. Some currencies, such as the Hong Kong dollar, have very low volatility, reflecting their pegging to the dollar. This doesn't mean that they have low risk. However, they are subject to devaluation risk, which is the risk that the currency peg could fail. This has happened to Thailand and Indonesia, which in 1996 had low volatility but converted to a floating exchange rate regime with much higher volatility in the later period. The typical impact of currency devaluation is illustrated in figure 11.1. Each currency has been scaled to unit value at the end of the month just before the devaluation. In previous months, we observe only small variation in exchange rates. In contrast, the devaluation itself leads to a dramatic drop in value ranging from 20% to an extreme 80% in the case of the rupiah. Currency risk is also related to other financial risk, in particular interest rate risk. Often, interest rates are raised in an effort to stem the depreciation of a currency, resulting in a positive correlation between the currency and the bond market. This interaction should be taken into account when designing scenarios for stress tests. Okay, what about correlation? Next, we briefly describe the correlation between these currencies against the US dollar. Generally, correlation are low, mostly in the range of minus 0.10 to 0.20. This indicates substantial benefits from holding a well-diversified currency portfolio. There are, however, blocks of currencies with very high correlation. European currencies such as the DKK, SEK, NOK, CHF have high correlation with each other, and the euro on the order of 0.90. The GBP also has high correlation with European currencies around 0.60 and 0.70. As a result, investing across European currencies does little to diversify risk from the viewpoint of US dollar-based investor. Cross-rate volatility. Exchange rates are expressed relative to a base currency, usually the dollar. The cross rate is the exchange rate between two currencies other than the reference currencies. For instance, say that S1 represents the dollar-pound rate and that S2 represents the dollar-euro rate. Then the euro-pound rate is given by the ratio. And you have the formula here. S3 is a euro Britain pounds equals S1 divided to the S2. Using logs, we can write logarithm S3 is equals logarithm S1 minus logarithm S2. The volatility of the cross rate is sigma in quadrat 3 equals sigma in quadrat 1 plus sigma in quadrat 2 and minus 2 to multiply p sigma 1 and sigma 2. So alternatively, this shows that we could infer the correlation coefficient P12 from the triplet of variances. Note that this assumes both the numerator and denominator are in the same currency. Otherwise, the log of this cross rate is the sum of the logs, and the negative sign in equation must be changed to a positive sign. So for today is all. It's over. Thank you for your attention. So goodbye. Thank you for your attention. Goodbye.